Since Kenya Kwanza assumed the office under the leadership of President William Ruto, we have seen concerted efforts by the president as he travels to different countries in a bid to attract foreign investments. And so today we'll have an interesting conversation with the Principal Secretary for Investment and Promotion, Mr. Abubakar Hassan, as we delve into matters foreign direct investments and weigh the balance between foreign direct investments and domestic direct investments. Thank you so much for having us. The first question. Since you assumed the office, Kenya has had quite a number of foreign investments. I am looking at the Kenya Polish Trade Forums, Kenya-India Business Forums, which happened last year. And this is on the backdrop of the government of Kenya, which has targeted attracting foreign investments as one of the key measures to achieving the economic pillar of Kenya Vision 2030. So why foreign investments?
Why foreign investment? Okay, first, let me give the context. Let me conceptualize and contextualize it. You know, when this administration came to power, it had some commitments to the Kenyan people. Those commitments need to be funded. Okay, how do you fund them? How do you fund them? One way of funding those commitments is through, for example, borrowing. But now it's very clear that we are in a hole, and where you're in a hole, you stop digging. So borrowing, it's not a feasible way to do it. So the second way to do it, it's through taxation. Okay? Because you need to raise capital to fund the commitments. You understand that there are some feeling that maybe, although it is not correct, that this country people are being overtaxed. Globally, we are basically undertaxing. But there has been a feeling that people are being overtaxed, and you can see our Finance Bill 2023, people have gone to court. What is the third way of doing it? The third way of doing it is through selling what you have. If you have a problem, you sell what you is in your possession, yeah? Like kama umeweka akiba, inaitwa akiba yozi na kusaidia siku ya dhiki, kwa kwetu tunasemanga hivyo. So another way of doing that is selling, privatizing state-owned entities by selling what the government has, so that you can fund the commitments. And that is why the president had assented to the Privatization Act to facilitate quick sale of state-owned entities. You can see that one, as all people have gone to court to stop it here. What is another way? Another way is to have a public-private partnership. Yeah, when private investors are coming through concessions and all that. People have also gone to court on concession on those partnerships. So you are left with private partnership, direct, only private partnership. Okay. So what is the status of the private investment in Kenya? It is divided, of course, into domestic investment and foreign investment. So your question is, why foreign investment? Foreign investment, because the contribution of foreign investment as a percentage of GDP is very low. It's less than 1% of our GDP. And if you look at the trend of the foreign investment since 2011, for the last 10 years, it has been dwindling. So we want to reverse that dwindling. And two, if you look at our manifesto, we have 6 impact areas. Anything we do, we must have an impact on building our forex reserves. It must have an impact of increasing our export. It must have an impact of creating jobs for our people. It must have an impact of reducing cost of living. It must have an impact of expanding our tax base. And most important, it must be inclusive. So foreign investment ticks most of the boxes that Kenya Kwanza impact matrix as far as the impact is concerned. So that's why we are focusing on foreign investments.
Where can we find the balance between the foreign direct investments and domestic direct investments to prevent an economic slowdown?
Balance. Of course, sometimes when we are aggressively promoting or attracting foreign investments, the foreign investors, they dominate certain economic activities, there are some negative social sentiments about that. Yeah. So we have two ways of managing that risk. One is to promote linkage between the foreign investors and the domestic investors by increasing the local content and strengthening, which will strengthen the productive capacity of our domestic enterprise. So when they come in, we want them to work with our domestic investors through a partnership, so that we can move at the same pace. But another way of doing it is to come up with a negative list, a section or subsection of the economy that foreign investors cannot touch. So we just be promoting those opportunities for the domestic investors. So that is what we are doing.
And the government has been quite responsive when it comes to international trade agreements. So maybe you can give examples on such agreements that the government has signed.
Okay, first we have an agreement with the US under the AGOA program. Then we also have another agreement with UK. It was signed, I believe, in 2020. We have just signed an economic partnership agreement with Europe. And I think this year we are hoping that we will sign a comprehensive economic partnership agreement with UAE.
What is the significance of these international agreements?
Very, very important, because when investors come in, what is the first thing they want to know is, or the first thing they want to mitigate as a risk is market risk. So they want to know the market potential of any given country. So in our country, what we are selling to them is that our country has a population of 50 million. If you produce, you have this market of 50 million people. But also our country is part of the East African community, which has a population of almost 300 people, right? But also if you come invest in Kenya, you can access the US market through the AGOA agreement. So if you come and invest in Kenya, you can also access the UK market, duty-free, quota-free, under that agreement. Now, if you come to invest in Kenya, you can also access the European market, which is a market of 27 countries, almost 400 million people, and a GDP of almost $4 trillion. So it enhances our competitiveness as a country.
Now that Kenya is now a signatory to the Economic Partnership Agreement with the European Union, so which sectors are you keen on protecting from competition from cheaply imported goods from the European Union?
It's not a trading issue. As far as I'm concerned, it's an investment issue. So once you invest, your product, you are able to sell to that European market. We are not talking of that we will be importing things which are cheaply done, but how we are packaging it is, if you invest in Kenya, whatever you're going to produce, you can sell to that market quota-free, duty-free.
The Ministry of Trade and Investments has been offering incentives which have been favorable to the business environment. So which existing packages of incentives do we have? And as we look forward to the future, which incentives will the government introduce? Many irresistible incentive package. First, our incentive package, we have general incentive package and specific incentive package. General, for example, in the Finance Act of 2023, we have incentivized almost all our priority sectors to attract investment. For example, in the pharmaceutical space, we have removed all supplies, all the purchase of supplies for the purposes of pharmaceutical manufacturing. So we have removed VAT on all supplies if you want to do manufacturing of pharmaceutical. We also removed all the VAT on supplies for building of specialized hospital. So in the health sector, that is what we have done. In the affordable housing space, we have also removed VAT on all supplies for the purposes of building affordable housing. In the agricultural sector, we have picked, for example, tea and coffee. We are saying that if you're going to purchase tea or coffee for the purposes of value addition, we are also removing VAT. We have also seen in the transport sector, we have removed all the taxes with respect to e-mobility,
right? We have also removed taxes if you want to assemble smartphones, and you can see some of the private investors have already responded to that. The president just launched the factory for manufacturing of smartphones. So there are so many general incentives that what we have, but most importantly, we have specific incentive package and our special economic zone program and our extra processing zone program, targeting on three major things. One is on the capital flow. The capital which gets into this zone, it gets in freely, and it gets out freely without any tax, right? If you get profit out of that, withholding tax on dividend, it's not it's zero. If there is withholding tax on interest, it's zero. So the capital moves in and moves out without any taxes. We also have incentive for the goods. Any goods which gets into the zone, it's tax-free. And if you export, you also don't pay. We also have the incentive package with respect to the entities that operate into those zones. Because once you create value, you need to be taxed on corporate tax. You do not, if you operate in an EPZ, you don't pay tax for the 10 years. And if you operate in an SEZ, you just pay 10%. However, if for the private equity investors, these are investors who wants to exit at a given time, if you also exit on companies which are in the SEZ or EPZ, you don't pay capital gain tax. So lots of incentives into those zones. But what we are focusing on now, going forward, we are focusing from general and specific incentives to basically having a clear framework on customized incentives, because there are people who will come here with big investments, and they will want customized incentives just to favor that to make sure that investment is realized. Okay, so we want to have a framework for customized, depending on your level of investment and impact it will have to our economy. How do we package a customized incentive to suit a certain investment with a given threshold? For example, if you bring a lot of money, we can see how we can focus on that. Two, we are also focusing on coming up with performance-linked incentives. You are aware that right now we have a program where we are meeting all the private sector to discuss their issues, the cost of business issues, and to see how we can intervene to reduce the cost. Maybe it can be either cost of taxation or cost of capital or cost of all the cost of energy. If we reduce, for example, we intervene to reduce a certain cost, what are you going to do for this government? How much money are you going to invest? How many people are you going to employ? You see, it's that kind of. So we are thinking of coming up with performance-linked incentives. That is in addition to the general and specific incentives that we currently have.
We have been witnessing many farms going into liquidation. So what will the government do to help such farms and prevent such occurrences in the future?
The three major costs which business faces is the cost of capital, cost of taxation, and cost of energy. So people go to liquidation under statutory management if they cannot pay, for example, their loans, right? So that means the problem there is the cost of capital. They're paying a lot of interest on their loans. However, in a life cycle of a business, you will start from business registration to operation to everything, and all companies must come in and must die eventually. What you should measure is how many companies are the ratio between those who are going down and those who are coming up. So if you look if you go to the bureau, the business registration service, there are more companies being registered than those companies which are going down. Yeah, so that should be the measure. However, on the cost issue, the cost of capital, the cost of taxation, and the cost of energy, the cabinet has approved a task force, formulation of a task force that will be dealing on cost of doing business, and it will be chaired by our CS, Honorable Rebecca Miano. We have already engaged the private sector to come forth with the issues they are facing, the cost issues. We've had the first inaugural meeting, I think, yesterday, and we are going to have the first meeting with them 1st February. We are going to have a working retreat with the private sector, just to identify the pain points and coming up with an action plan. And His Excellency the President will meet the private sector in March, after we have firmed up the position that the big ticket issues that will need the President to intervene.
There has been quite a significant growth in the industrial and manufacturing sectors, more so in the special economic zones. So first, tell us, what are special economic zones?
Special economic zones. So this State Department has been given 5 tools to attract investments, to attract investment or to increase, to expand the existing investment. One of the tools is special economic zone, and it is similar to export processing zone. So these are tools for attracting, facilitating, and enabling investments. Okay, private investment and in particular foreign investment. So when you set up there, they are reduced. There are fiscal incentives there. You pay less tax than others who operate in outside the zones. You get quality infrastructure because it is somewhere where everything is there. Water, power, and if it is an SEZ which is port linked, it will be near, for example, Dongo Kundu is near the port, the Naivasha one is near the inland, the dry port. So it is a zone which is enable infrastructure to support business, and the regulation in that zones are a bit relaxed, and the fiscal incentives, you pay less taxes.
While the zones have attracted foreign direct investments, how will they promote export-oriented industries?
Because first of all, let me tell you the difference between the EPZ and SEZ. These tools are supposed to facilitate or spur export growth. Because if you set up in an EPZ, it is focused on you are to export 100% of what you produce. If you sell to the market, you can only sell up to 20% to the local market. In an SEZ, the market access regime around it is you can export 100% and also sell to the domestic market 100%. If you sell to the domestic market, you pay the taxes. So it doesn't, if you operate in an SEZ or an APZ and you decide to sell into the domestic market to Kenya, you will pay the taxes. So we are promoting export by asking you to set up there and export. That's how we are making them as an export promotion tool.
Last question, what measures are in place to ensure the benefits of special economic zones are shared equitably amongst different regions in Kenya?
Okay, first of all, the government has put a program called nationalization of industry. Yeah, we are nationalizing the industrial space, where each and every county will have a county aggregation and industrial park. So in terms of industry, we are nationalizing it. Yeah, everywhere in each county will have access to industrial jobs for our youth. Okay. With respect to EPZ or SEZ, since these zones are supposed to be focusing on export, yeah, people needs to be, the investors need to see a zone which is near the ocean, for example, near the port. So for those counties which have that distribution network, for example, Mombasa, we have Dongo Kundu Special Economic Zone. Lamu, there's a port there. We have a Lapset Special Economic Zone. We have a dry port in Naivasha. So most SEZ, they want to be either linked to ocean or linked to airport. So it depends. That is how the model is like that. So we cannot have EPZ all over the country. However, His Excellency the President has already instructed and we have already gazetted 5 more EPZs in different counties. We have one in Murang'a, one in Kirinyaga, another one in Uasin Gishu, another one in Busia, and another one in Nakuru. We have already advertised for the development of those zones. In the next 6 months, they will be ready for investor entry. His Excellency the President will be launching them.
On to the world of stocks. The market closed the week on a bullish note with the Nairobi Securities Exchange All Share Index 10, 20 and 25 share indices gaining 2.2%, 2.8%, 1.0%, and 2.3% week-over-week, respectively. Safaricom dominated market activity at 39.8% of the week's turnover levels. The counter gained 3.1% week-over-week to 13.50 Kenya shillings. East Africa Breweries Limited was the week's best performing top mover on an 8.6% week-on-week recovery to 113.50 Kenya shillings. Uchumi Supermarket was the leading gainer of the week on an 11.1% week-over-week rally to 0.20 Kenya shillings, while Sanlam was the leading loser, shedding 9.7% week-over-week to 6.34 Kenya shillings. Cooperative Bank of Kenya, the trustee of Ilam Fahari Income Real Estate Investment Trust, issued a public notice on delisting the Income Real Estate Investment Trust from the main investment market segment of the BOurse effective 12 February 2024. The last trading day will be 9th February 2024. Ilam Fahari Income Real Estate Investment Trust is in the process of applying for admission for trading over the counter on the unquoted securities platform on the BOurse. Thank you so much for joining us, and to get the entire interview, tune into our digital platforms at TV47 Kenya. My name is Natasha Wairimu. Do have yourselves a lovely evening.